And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. The Bitcoin ETF launch was one of the most successful product launches in financial history. No exaggeration. There is now roughly $113 billion in Bitcoin ETFs. That's a little more than 1% of the assets under management of all ETFs. So what is next for Bitcoin ETFs in 2025? Let's talk with Samara Cohen. She's the Chief Investment Officer of the ETF and Index Investment Business for BlackRock. She runs the ETF business at BlackRock. That's what she does. She also runs the largest Bitcoin ETF, the iShares Bitcoin Trust. Mike Aiken's also here from ETF Action, my friend and all-around ETF expert. Samara, from almost nothing to what, over $100 billion in assets? IBIT has half of those. Congratulations. How do you explain the success? Is it just retail investors, a great up year with the price of Bitcoin? Is it the ETF Rapper? I mean, explain how.
It's all of those things combined, Bob. It is both interest in Bitcoin and then confidence in the ETF Rapper, which came together in 2024, where there was a bridge between the two worlds. Now there are kind of three broad investor bases: individual investors, wealth advisors, and institutions. To your point, individual investors were really the driving investor base in 2024. But also there were a lot of crypto native investors that preferred the ETF Rapper and simply swapped wrappers for their existing Bitcoin investments. So it was both of those things that came together for all of that.
Mike, do you agree with that? I mean, it seems like the ETF Rapper, I know I'm an ETF guy, but it certainly attracted a new set of investors. Why is that? And give us your take on why this product was so spectacularly successful.
Yeah, I mean, I think the ETF Rapper is still undefeated when it comes to terms of getting access to liquid asset classes in an efficient wrapper and a meaningful way to trade it. So just, if you ask me if I'm going to invest in Bitcoin, and I could do it on an exchange like Coinbase, or that's got, somewhat oversight, but not a lot, or if I do it in a hard wallet or do it through a firm like BlackRock or Fidelity, I'm going to pick BlackRock and Fidelity every day of the week and twice on Sunday. So I think the wrapper is a big part of this component. There's clearly demand for this asset class for these types of digital investments, but the ETF Rapper provides a whole new level of security to that. In terms of where the demand's coming from, I mean, I think Samara hit it. If you look at the ownership of the data that we currently have as of 9/30, a lot of it is being driven by the retail market, because we can't trace the ownership back to 13F filings. And what I mean by that is 60% of all ETF assets can be traced back to 13F filings here in the US. Only about 25% of the cryptocurrency can be traced back, and a lot of that is through IBIT, which is the BlackRock product. So, and of that, most of it is hedge funds, not investment advisors. So clearly the demand currently is hedge fund driven and from the retail side of the coin.
Let's spin this ahead, Samara. Let's talk about new products for 2025. 2024 was the year of the spot Bitcoin ETFs. I keep calling 2025 story maybe Bitcoin plus ETFs. That is, we're hearing about ETFs that might combine with Bitcoin with active management or with leverage or with options, even downside protection. Your take on this? Is this good news? It seems to be getting more complicated at this point, but is that the natural evolution of the product?
Innovation and complexity always go hand in hand. I think what's critically important to investors right now is portfolio diversification. Because recall, 22 was a scary year for investors, where you had historically bonds and equities both going down together. 2023 saw rising rates, and you were able to be defensively positioned in 2023. But now as investors look to re-risk, they want to have a diversified portfolio and think, in addition to the traditional 60-40 kind of equity bond positioning, what might add some ballast to their portfolios. And that's where you start to see these buffered ETFs that provide limited downside. Certainly crypto ETFs, new investors looking at incorporating gold ETFs into their, so I would kind of first frame innovation in that category.
So this is part of a larger trend. You're putting Bitcoins in a larger trend of people looking to diversify, in some cases looking to provide downside protection, like we've seen in people buying buffered S&P products, for example. So you're seeing there's a larger thing going on here.
Particularly given the concentration that we've seen in U.S. markets globally, and even within U.S. markets, investors looking for assets that don't have the same drivers of return.
Yeah. Mike, it does seem, I'm picking up on this trend, it seems like the ETF industry does want to broaden things out a lot. Some say make it more complicated. I noted last week Calamos announced that it will launch a structured protection ETF to give investors a way to capture some of Bitcoin's upside with downside protection. So things are getting definitely broader and more complicated at this point. Is this good news or bad news for the industry?
Well, I suppose a little bit of both. All good things come with a little bit of bad things. I worry a little bit if you break down the market last year. You think about kind of two areas that really exploded in terms of product growth. You saw speculative assets or very risk-on assets explode. A lot of that being driven by the retail. And when I say that, I include crypto in that space. I do think the majority of people that are investing in crypto right now, the retail side, are doing it because they think they're going to get really good returns, and that is really the sole reason they're doing it. And you can link into that the single stock ETFs, right? We've got now $27 billion in single stock ETFs broken in across mostly leveraged inverse, but also synthetic incomes. All of these single stock names are across technology names, more volatile names, folks that are looking to make a very aggressive play into the market. And then the flip side is you have what I would say risk off side of the explosion of the market, which is more of the synthetic income, broad-based synthetic income, the explosion in buffer ETFs that we've seen, both in terms of number of products and the AUM following them. So it's really kind of interesting dynamic where you've got kind of the gamification of the ETF market, which I don't necessarily think that's a good thing long term. And then you have the, I guess, more maturing of the ETF market, where you're seeing a lot of products that have been around in mutual fund format for a long time, but now becoming available in the ETF Rapper.
Yeah, it's definitely gotten a lot more complicated. You used the word gamification. I'm not sure I would use exactly that word, but it's certainly a little bit, it's part of the maturity process, right? The increasing complexity is a characterization of markets, right? You tend to offer simpler products, like a spot Bitcoin ETF, then you start offering options. Now you can even offer some downside protection. The way you were characterizing this is a normal situation. It doesn't mean people should necessarily buy any of these products, but it's a normal trend in the financial markets, right?
That's right, and I think a very important characteristic to keep in mind with today's markets is that the fastest growing sector really is a newer sector of individual investors, self-directed investors, and that changes markets. Self-directed investors, want more bang for their buck and will be more interested in, a derivatives embedded product, and so that is a characteristic of innovation. They're more interested in options. That's part of the explanation of the kind of growth in options, growth in short-dated options. And so as markets look to embrace those new investors, they become more complex because they have more products for more investor types.
Mike, as the curmudgeon here, maybe what you need to do is explain to people how difficult it is to make money in the options business. It's the dealers that make the money, just like in sports betting. And maybe people like you need to do an education. But I agree with Samara. I mean, it's a very natural part of the evolution of financial products. Go ahead, Mike.
I was going to say, I think, if you think about an asset manager's job, there's to deliver product, good, clean, well-protected, well-designed product to their audience, right? And I think the industry is doing an incredible job of that. Now, the people that are using those products with the democratization and the less barriers to entry into some of these strategies, that potentially is going to have some downfalls when you're talking about that complicated nature. I mean, some of these single stock ETFs that have been filed recently, they haven't been listed, but a few of them in the quantum space a couple weeks back had bigger than 50% drawdowns in one day. If you had a 2x leverage on those types of products, on those days, they would have been kaput, right? I mean, 2x of 50%, you basically would have gone away. So I think people need to understand that there's a large level of risk that comes with leverage and inverse, and we're seeing that explosion in that space. I mean, crypto as well, right? Crypto's already a volatile space. I think there's like $7 billion in leveraged inverse crypto products at this point, and the market as a whole has like an 11-to-1 ratio on the ETF market of leveraged products to inverse products, which is the highest I've ever seen it.
Yeah, we have expressed these concerns before, that there could be even systemic risks associated with this, where you actually do some real damage to the underlying assets in the case of too much leverage. But let's move on here. Samara, I want to talk to you about what we can expect from the Trump administration on policy in 2025. Does BlackRock have any thoughts on Trump, Congress, Bitcoin 2025?
Yeah, look, we've been talking about innovation, and I think that is the story going forward, and I'm really excited and optimistic around the opportunity to do what we do really well in U.S. markets, which is support innovation and combine it with effective and smart investor guardrails. So going back to Mike's point, I don't disagree generally with what he said. Absolutely, education is critically important so investors know what they're getting, but we want them to have the broadest choices possible. And I'd remind us, one of the really interesting pieces of data that came out of that Q1 2021 spike that we saw in retail participation is a lot of those investors who kind of came to the market for leverage and meme stocks stayed because they moved into index and ETP products. So sometimes that journey goes from saver to trader to investor, and you bring investors in, they learn more, they take advantage of what's there for education, they get some hands-on experience, and they become long-term investors.
The key and the hope here is nothing blows up in between, and they throw up their hands and say, I just lost all my money, I don't want to come back. And we want to keep them long-term.
That's right. That's
so
why
young people are less risk averse than older people. By definition, they're not so worried about taking those kinds of risks. But as Mike said, there could be a serious downside here if we have a downturn.
Education and guardrails together are required to make sure you maintain confidence in the markets.
Just on the Trump administration and Congress, is there any thoughts here about what if any kind of legislation? Are we going to get better clarity? Do you have any confidence we will?
I think absolutely, but let's recall, digital assets really at this point feel like a bipartisan issue. I think there will be progress made on Fit 21, there will be progress made on stable coins, there will be progress made just on definitions and taxonomy, and most importantly, I think we will increasingly create more clarity for traditional finance participants to find the place in digital assets that make sense for their businesses, which really grows the ecosystem for investors. So I think all of those things will happen.
Mike, what your take on any legislation or anything out of the Trump administration? I mean, there was talk that Trump administration might consider establishing a strategic Bitcoin reserve, kind of like a parallel gold, in which Bitcoin would be secured as a financial hedge from the US dollar, like gold is right now. Thoughts on this?
I think there'll be less roadblocks, right? I think there'll be less regulations with the Trump administration trying to slow digital assets. I think as far as a tailwind from in terms of a strategic asset or things like that, I just don't think that government moves that quickly. I don't think that's something that will make its way into the decision process, certainly not in 2025. There may be a lot of discussions about it to see something officially happen, but I even am very skeptical that happens ever. I think there's a weird dynamic playing out with use cases of these digital products, right? There's no denying the underlying technology of tokenization and what it can do for a number of different industries, including finance, breaking down barriers to entry, creating more efficiencies, all of really good things that technology has been doing across the board. But then there's that it backs into this idea of decentralization, which is a naive way to think about finance in my opinion, but it kind of backs into each other and really doesn't make sense when you try to put the two together in terms of an investment case for digital assets as a currency, if you will. So I think we're going to have a lot of discussion about it, and I think that obviously Congress and the Trump administration is clearly pro, and I think Congress is very interested in talking about it. I'm not sure that they're ready to leap in and be a tailwind to this space anytime soon.
Okay, I'm going to just move on here and talk about flows for 2025. A lot of the buyers still seem to be retail and hedge funds, but getting institutions more interested seems to be the key to increasing assets under management. Talk about that. What does BlackRock anticipate?
Yeah. No, that's right. And as Mike said, hedge funds have been the largest part of the institutional category. And part of that is that there's just less plumbing involved for a hedge fund to participate in a new asset class. With institutions, there is, new investment guidelines, board approvals, and most importantly, really kind of the long-term risk analytics and work being done to look at portfolio interactions to figure out, like, how does Bitcoin play in my investment strategy? So unquestionably, and we probably knew this a year ago, institutions will have a much longer tailwind. And of course, what's also going to be important is that this is a relatively young asset class with a meaningful trading history that's still 10 years old. Like, Bitcoin started trading, in its first transaction was in,
2008?
Well, the paper came out in 2008, but there wasn't really any transaction happening on the network until 2010. So, this is an asset class around which people have to do work and incorporate into their risk systems. So that will be the longer term pace of institutional uptake.
I got to ask about the price of Bitcoin. I know you're not a commentator on Bitcoin prices, but it's been under some selling pressure recently. I think we're 15% off of the recent high in December. Any thought on what's causing that? I know I had some people comment that we crossed the 1 year mark. That brings us into the long-term capital gains territory. Some people might decide to start taking some profits here. Some cited the government's decision. They were going to sell, 69,000 Bitcoins they just announced. Recently as a factor. I don't know, any thoughts on what's causing some of the weakness?
Yeah, well, number one, let's remember, Bitcoin is a risky asset. So 15% in the context of Bitcoin is not an enormous move. Investors should expect volatility in Bitcoin as an asset, and that's kind of a prerequisite to determining that it's a place in which you want to participate. So certainly there was a big run up to the end of the year. So for the reasons that you said, it makes sense that we would have a pullback. But in the long term, the price of Bitcoin is really going to be determined by the level and pace of adoption. And that is something that, again, will unfold over the long term.
Mike, is it fair to talk about gold ETFs as a parallel to Bitcoin ETFs? So the Bitcoin bulls are saying this is what happened with gold ETFs, Bob. Gold ETFs help popularize a safe and easy way to go and own gold. Instead of you have to have gold bars and you lose the gold, or you can't find them. Now you have a safe place. That's going to be true for ETFs. That's helping drive broader ownership of ETFs. Is there a parallel there with gold ETFs?
I think that's a fair statement to say that from an access perspective, right? So if you just keep it on the concept of accessing gold, the ETF made that much easier. It made it much easier to do in context of a portfolio. The same thing is happening to the crypto space with IBIT, with FBTC, with the other Bitcoin ETFs that are out there. It is creating a more meaningful way to access, and really, if it plays out, a much more meaningful way for investment advisors, financial advisors to allocate for their clients and control it in the context of an overall portfolio, right? Nobody was having, loads of gold bars delivered to their branches at Merrill Lynch or any of these offices. But when the gold ETF came around, it created it as an asset class. In terms of price, just to hop on that just 1 second, I think the only story is supply and demand, right? So if the story of Bitcoin continues to play out and people buy into the narrative of a store of value, there is more demand than there is supply. The price is going to go up, and that's really the only way you can possibly price this asset. I think the real risk and interesting part of this will play out is right now it is a very risky asset, trades at a much closer correlation and a higher beta to something like NVIDIA than it does to any other commodity that trades with some sort of rationale to the economy. And where this will get interesting is price discovery, in the sense that if NVIDIA were to drop 50% today, there's a lot of analysts out there that can turn around and tell you exactly what that means from a valuation multiples to its underlying business. That doesn't exist in this space. It's purely supply and demand. And I think that is something that's going to be a challenge for this entire idea of investing in the crypto tokens.
But that's true of gold
over
too,
the
right?
long
This
term.
is the argument. They always said, you know, there's nothing behind what's the fundamentals. Well, there is a use case for gold. It does have jewelry, for example, industrial uses. But this, you know, the argument that there isn't anything really behind Bitcoin, it's a belief system and a hope for a store of value. He's right. There's no fundamentals, but this is true of collectibles. I collect rock posters from the 60s, for example. What is that rock poster worth? It doesn't throw off any income, doesn't do anything. It sits on my wall. And it's worth whatever anybody will pay me if I try to sell it.
Yeah.
So in a sense, there's a belief system around almost any collectible.
It's true for Bitcoin, it's true for gold. I think one of the differences here is that Bitcoin may reach a state of maturity where it behaves much more, where investors really do look at it much more similarly than they look at as they look at gold. Whereas right now, because there's this uncertainty and potential trajectory around adoption, there's a bit of a difference right now in terms of how investors will look at Bitcoin versus gold. So in thinking about portfolio implications, I think there is phase A during the initial adoption phase of Bitcoin, and then, you know, phase B, how Bitcoin behaves when it's more mature and we've reached a target state of adoption.
I know you're not in charge of product development, but what can we expect from BlackRock in 2025 in this space?
We're looking across that whole suite of alternatives that we talked about in order to provide a really broad group of investors with what they need for their portfolios. So, you know, something we talked about earlier and Mike mentioned is a concentration in U.S. stocks. And we talked about, you know, dynamics with individual investors who are coming to market. A lot of investors want to participate in the market with stocks that they know have largely driven returns in the market in recent years. So, you know, we have a top 20 product.
Top T.
Top T, yes.
Yeah. You just launched that, right?
Yes,
it's
that's
the
right.
top 20 S&P 500 stocks. How's
That's
it
right.
doing?
It's doing well. It's new, and it's to your point about complexity. This is an ETF that is very easily understood with names that are familiar to investors, and there are investors to whom that's very important. There's also investors who are embracing the complexity of buffered ETFs that allow them to come back into the market but limit their downsides, and particularly investors who are largely in cash but who have longer time horizons and know they need some sort of equitization. That, you know, increased complexity of the derivatives product is important for them.
Okay, so and I'm glad we got into the top T thing, because even though it's down from the start of the year, what I like about the top 20 is if you look at the top 10, you're essentially all tech, except maybe Berkshire's in there in the top 10. But once you get past there, you're into Berkshire, you're into Lilly, you're into Exxon. You get a little more diversification.
Yeah, that's a great point.
Instead of just the top 10 tech ETFs. Fascinating discussion, folks. We're going to be on top of the Bitcoin ETF. You know why? Because I get emails from you asking about where it's going and what new products are available. Two of the smartest people in the business here you see with us today on ETF Edge. That does it for this week's show. My thanks to Samara and to Mike. We've asked Mike to stick around to provide us a little more perspective on ETF trends in 2025 for the ETF Edge podcast coming up. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.